Okay, we're going to get started. We actually did the webinar earlier this week, and there were some technical difficulties, so I'm re-recording it, but I will make an effort to answer the questions that came up on that call, and I'm always available offline by email. Okay, so the goal for today's session is really to give everyone an overview of commercial real estate and specifically how to think about passive investing in commercial real estate. So let's dive in. Okay, quick disclaimer. All of the views shared today are my own. They are not an official position by BCG, and this does not constitute financial or tax advice, which you should seek an advisor for. So why don't we keep going? Okay, a bit about me. My name is Pat O'Brien. I am a principal at BCG in our industrials and MSP practices. Prior to BCG, I worked in investing with a firm called Ulico here in Chicago, investing in both commercial real estate and clean energy assets, primarily debt and some minority equity stakes. And then over the last year or so, I have begun investing part of my own portfolio in real estate as a limited partner. I'm in 375 doors and counting. And then through a firm I created last year called Archline Equity, I've also started to partner with some of the sponsors that I have invested in to help them put together deals going forward. Apart from that training, I did my MBA at U Chicago, studied real estate at Georgetown before working at that investment firm, and my alma mater is Missouri. I currently live in St. Louis, which is also where I grew up, and I'm married with two young kids. So why are we talking about real estate? Well, for me, some of my key investing goals were to compound my wealth over time, to create flexibility with my time and finances. And I think real estate is a really good way to do that, and we'll dig into that more today. Okay, so what I felt my portfolio was missing, and you may feel the same for yours, was true diversification outside of the public markets. I know stocks have done really well over the past few years, but I just don't really like the volatility of putting all my eggs in the public markets basket, so to speak. And so, real estate, I think, offers stable, non-correlated cash flows, particularly in the asset classes that I'm looking most at, which is multifamily, and offers tax advantage treatment through losses and deferrals of taxes over time to delay the tax bill. Ultimately, we'll get more into this today, but for me, I think real estate offers asymmetric upside while protecting the downside if you're investing in the deals with conservative underwriting that I prefer. And we'll get into more of what that looks like. Okay, but before we do, I think just quickly, when we talk about commercial real estate, that can mean a lot of things. Broadly, the way I think of it is, real estate is anywhere with land, but I think it's either where people live, be it multifamily apartment buildings or senior living facilities, or self-storage units that are an extension of their home, and even hospitality and hotels, or it's places where people work, office, retail, medical office, industrial. And among these asset classes, I am particularly attracted to multifamily because I think it's a really resilient asset class. There will always be demand for housing. When you invest in a 200-unit apartment building with tenants from all different industries, you get built-in diversification of that income, and the properties themselves benefit from economies of scale. So that's an asset class I've been focused on. I've also been exploring a couple of these others in more detail, and in my prior role, invested in almost all of the ones on the page. So happy to share more about those, but I'll focus most of the session today around multifamily. Okay, so for folks who either own a home or have bought a home or condo units that they've chosen to rent out, that would be considered active investing. What I want to do is contrast that to passive investing in multifamily commercial real estate on a few of the key dimensions that I think are important. The first is control. So if you own your own rental, you have high control over what you're buying and what market it is, as well as your operational decisions, what tenants you're bringing in, what you charge them, what improvements you make to the units. So high control, passive real estate, you do have control over which deals you invest in and which markets with which sponsors, but you have no involvement in the operations of that property. So you need to get comfortable with what the business case is up front. Sort of the inverse of the control, though, is you don't get a lot of leverage when you're renting out single family homes. You got to do a lot of the work yourself, or you're hiring contractors, may fall through. Whereas in passive real estate investing, there's a significant amount of leverage because the team that you're investing with is looking for the asset, executing the business plan, selling the asset, and paying you and updating you along the way. So not a lot of time requirement once you've invested in an asset on the commercial side, but an ongoing potential headache as a landlord on the rental side. It doesn't mean there's no time spent. I think in single family rentals, you're spending time everywhere from acquisition to operations. On the commercial side, as a passive investor, you're really pulling the time forward as to where you need to focus, which is judgment around the asset class, the markets you're comfortable with, ultimately the sponsors, and the deals and assumptions of those deals that you're underwriting. So it all moves forward. Once you invest, you're really getting a check and an email every quarter, sometimes monthly, and year-end tax filings from the team. So it frees up a lot of your time as long as you're pulling that judgment forward. I think because of that, commercial real estate for me is something that's much easier to scale. I've invested again in several hundred units without a ton of work, and I think the subsequent investments will be even easier because I've now identified a handful of teams that I feel really confident in their ability to execute. So if time is something that matters to you and you want to scale, I believe passive investing in real estate can be a really good avenue for that. Okay, so let's get a little bit into how are returns actually achieved and take a look at an example of a multifamily asset. So let's say we buy a 100-unit apartment building at a purchase price of $10 million. So that's $100,000 a unit. Pretty standard in a lot of Midwestern markets. We put down $4 million of equity, so 60% leverage, again, pretty standard and fairly conservative for this asset class. And through adding value, we are able to raise rents $300 per month on those units. And adding value may mean we're putting in a washer and dryer in the unit, charging for utilities if that hadn't been done, updating finishes. So a lot of things that can be done, but there needs to be real value and justification to be able to charge our tenants more or bring in new tenants that are willing to pay more. But if we're able to do that, 100 units times $300 times 12 months, that's $360,000 of new cash flow at the same expense base that we've been able to create. And that value actually would translate on average, depending on the market you're in, to $6 million of value created for the building. And the reason for that is because unlike single family homes where the value of the asset depends on what the value of the assets are next to it, because it's what someone's willing to pay to own that home. In commercial real estate, properties are valued based on the cash flow they generate. Oftentimes, pension funds, insurance companies, private equity funds are buying these assets for the cash flow. And so the cap rate is just a way of valuing that cash flow. And this in this case, we're saying a 6% cap rate is what the cash flows in that property should be valued at. All in all, though, if we raise the rents, create value as an investor in that property, we would be receiving the cash flows from the monthly rents, as well as the value created from being able to raise that rent. And we actually receive the value either when the property is sold or when it's refinanced. So in this case, 60% leverage, we could go back to the bank after even the first year and say, hey, we got a new appraisal for the building based on generating $360,000 of new income. We would like to keep our 60% leverage, but now on the additional $6 million we've created, and go get a loan for $3.6 million. So it's it's real. It's called forced appreciation. You're not depending on the market just taking off. You can actually create real value tangibly. So that's how it works at a simple level. And I think, again, this is a pretty unique asset class in that it provides cash flow. The underlying asset can appreciate either through forced appreciation like this, and or through the market doing well. I can certainly think of some markets in the US where that's been the case. There are tax benefits from being able to take a lot of paper losses in the first year from depreciation and deferring tax payment over the whole period until the end. We can also take what I would consider to be conservative leverage on the property to improve returns. So in this case, taking out 60% loan to value might mean that the cash flows at the end of the month cover our debt service plus 30, 40, 50% buffer, which to me feels like a safe amount of debt to take out on a property. And at least in multifamily, we're satisfying a basic need. So this is part of the reason it's been the focus of my portfolio. I don't think you can do all this and get, it's not like Bitcoin. You're not going to get rich quick in a year, but over the long run, it has the ability to compound your wealth over time. And we'll get into some numbers about what I think that can and often does look like. Okay, before we do that, though, maybe just to step back in terms of the ways you can invest in commercial real estate. In my mind, you can either do it through the public markets by investing in REITs, but for some of the reasons I mentioned a couple pages earlier, you are still exposed to the volatility of the public markets. Not a bad option because you obviously get more liquidity. The alternative is investing in commercial real estate through the private markets. And you can either do that by investing in a fund, like a real estate private equity fund, that's buying a bunch of assets and selling them over time, or by investing in individual assets, either directly yourself or through a syndication. Syndications are how I have been investing. So I'll briefly cover how it works. Essentially, you create, or the sponsor creates, a holding company. Limited partners or passive investors are contributing most of the capital into that holding company, while experienced operators, or what are often called the general partners, are contributing their time and effort, and usually 5 to 10% of the capital required, of the equity required. And that holding company then buys and owns and manages the property itself. So ultimately, you are investing. A team of experienced people are doing the work, and then jointly everyone shares in the upside of the value created through the investment. Okay, so that's kind of the structure of a syndication. How you as a limited partner get paid through that is shared on the page here. And really, there's 3 ways returns are realized. The first is through ongoing distributions, which are the cash flows from monthly rent less expenses. The second would be profits from selling the asset after several years and or refinancing the asset after you have forced appreciation, where you can take on more leverage in the property. And then the third are tax benefits, which would be specific to you as a limited partner in your tax bracket and situation, but you would receive those paper losses and be able to defer tax payment through the investment. So the way it flows then on the right-hand side of the page is really just the cash flows or the profits or the refinancing at the top first go to pay a preferred return to the limited partners, or at least in many of the deals. And that preferred return is generally 6 to 8%. So LPs get paid that first. Then any of the profit that is remaining is split between the limited partners and the general partner. Often I've seen 70-30, sometimes you'll see 80-20. I've even seen 50-50. So the splits can differ, but that's how the economics typically flow. Okay, so to make it a bit more tangible then, this is an illustrative return profile of a multifamily investment. I would say it's fairly common to see returns that look like this, or at least projected returns that look like this. So if you make an initial investment of $100,000 in year one, you may get some annual cash flow. But again, because we're trying to force appreciation, it may not be your 6 to 8%, because we're using the cash from our investors to go improve the property. In year two, then maybe most of those improvements are done. Let's say you get a $7,000 cash flow. We've pretty much achieved the improvements that are driving a lot of the rent increases. In year three, not all the time, but sometimes the sponsor will then go look to refinance or take out a supplemental loan on the property, and you'll get a chunk of your initial investment back. So it's return of capital. And then by the end of the whole period, oftentimes that's targeted around 5 years. When the asset is sold, you would get the remainder of your initial investment back, as well as incremental proceeds from the sale. So in this case, if you invested $100,000, by the end of 5 years, you would be projected to get $200,000 back before you pay taxes on that, which I think is a great return. In this case, you're averaging a 7% annual cash flow. If you look at the timing of these cash flows, it's 18 or 19% IRR. And again, it's a hard asset. So if the market's not great in year 5, we can just hold it and continue to get cash flows from the asset. Perhaps we refinance it again. I really like the characteristics of this. So this is what a typical investment could look like in the multifamily space. If we go forward, I'll just share a couple investments that I have made over the last 6 months. One was an investment in Anderson, Indiana, which is a town about 40 miles northeast of Indianapolis. Diverse employment base, benefiting a lot from the growth in the Indianapolis market. And this asset was 72 units, an older build, 1965, pretty much fully occupied, 95% occupied. And relatively speaking, a small asset. So purchase price close to $5 million, a little bit of capital improvement budget, came out to $72,000 per unit. The team put 75% fixed debt on the property to make the acquisition and bought it at what I thought was a pretty fair price. Again, that cap rate in terms of what you value the cash flows at was just under 7% based on prior years net operating income. And based on what the team projected, they were actually buying it closer to 8% or 7.8% based on their year one cash flow projections. So, part of what made this asset attractive was they were buying it at a fair price. When they looked at comparable properties around it, the rents were about $50 below comps on many of the units, and they had a clear business plan to add value. In this case, tenants were not being charged for utilities, which was common on most buildings, so they were able to pass that through. They did some updates to the interiors of the units and projected through doing those things that they would be able to increase rents by $70 to $100 over the course of the hold period, which was 3 to 5 years. And the team itself has been in this market, has gone full cycle on another asset, owns a different asset 10 minutes down the street. High integrity, experienced, again, in this asset class and in this local market. And we're actually going to use the property manager from one of their other properties to also manage this. So someone who really knows the market well and was aligned in terms of incentives. So I really liked the deal. The team's been ahead of business plan throughout the 6-month hold period so far. And this one is projected to return a little bit over 2 times equity. That's equity multiple, north of 20% IRR, which is amazing, and a 9% cash on cash return. So above that pref, additional profits that are split 70-30, limited partners are expected to get about a 9% return on their investment until the sale period. So a great asset, and hopefully a team I'll be able to invest with more in the future. The second example is an asset that I invested in Tampa Bay, Florida. So this was a different operator. They have a large property management team. I think they manage over 20,000 units in Florida and Texas and a couple other markets. And they bought this asset over the summer. It's a little over 300 units, was built in 1975, but renovated less than 10 years ago. So it's fully occupied. They bought it at, I think it was 10 million less than the building was valued at just 2 or 3 years ago, when rates were high and there wasn't as much excess supply on the market. So I think they're getting at a really fair price, $178,000 a unit. They similarly took out fixed rate debt and actually had a preferred equity investor taking a big chunk of the capital stack. And so what made this one attractive to me was, again, a seasoned operator with a long track record in this market. They had gone full cycle on over 80 deals, never lost investors' capital. And we're going to be vertically integrated in this property, so very aligned incentives in terms of the property management. The asset itself, the comps within just blocks of this for similar Class B assets were $200 to $300. They were $200 to $300 lower than those comps in the rents, and again had a very clear business plan to install in-unit washers and dryers, which should be able to bump rents about $150 a unit. And they had tenants already saying they would gladly pay that. And then they were also updating some of the finishes of the interior of the units. So over 5 years, getting to what the comps were already at this year felt pretty reasonable to me. So another great deal, I think, and I'm looking forward to working with this team more. The projected returns on this are pretty amazing. North of 2 times equity multiple, close to 25% IRR projected, and there will be a refi in year 3 after they do this value add, and I would expect to get 50 to 60% of that initial capital back off the table in year 3. So hopefully this gives you a little bit of a flavor of what some multifamily investment can look like, and the sorts of variables that I look at when I've underwritten these properties. I've put together a much more detailed, and certainly look at a more detailed version of a diligence checklist, but I tried to simplify here in terms of some of the key factors that are important to consider when vetting a deal. The first set of factors are around the market. So you want to understand, is the market growing in terms of jobs, income, and population? Jobs, I would say, is the most important of those 3. And then at least in multifamily, a good location is better for rents and the likelihood to be able to rent the unit out over time. So proximity to schools and jobs is important. And then for the asset itself, it's important to understand what is the business plan in terms of how value will be added, or if it's a new development or just a stabilized asset where you're buying the cash flow over time. And then the valuation and the projected returns really depend on 4 or 5 key assumptions. So looking at rent growth, looking at the cap rate that is assumed at exit, looking at the expense ratio, these are all really critical things. Any deal you look at is probably going to look good on paper because you can tweak these assumptions and make them look good. But I generally look for rent growth that is not faster than 2 to 3% a year, an exit cap rate that is the same or higher than the going in cap rate. Otherwise, you're banking on market tailwinds providing the return projections, and an expense ratio that's in line with the market and expectations for that asset class. The third set of variables then is around the team, and this is probably the most critical. It's really important to understand the sponsor, the general partner's level of experience and track record, both in that asset class and in that market. Ideally, they will have gone full cycle already on at least a deal or two in that market and proven that they can execute a business plan and exit the property and achieve projected returns. And I personally like to invest with sponsors who are vertically integrated and do their own property management, because then incentives are fully aligned. It's not necessary. So if they do have a third-party property manager, understanding who that is and what the experience of the property manager in the market is also very important. If you want to learn more and get a more detailed checklist, I have put one together. I'll share at the end of the session a link for where I've posted that along with a few other resources. Okay, so if you put it all together, I think the key takeaway with passive investing is, again, what's important is where you're applying a judgment compared to active investing. And so there's 3 key implications. One is that a lot of the benefits come from how the deal is structured, what leverage is used, what assumptions are in the business model, are incentives aligned between the teams. So understanding that structure and looking for the right structure is important. The second piece then is where you're spending your time is upfront, not just looking at the structure, but also then underwriting who the partners are, what are the risk trade-offs, and doing that before you invest. The third piece I would say is we've talked a lot about an individual asset or an individual deal, but I think given some of the tax benefits and the way it's treated, looking at commercial real estate on a portfolio level and how you plan to ladder your investments over time and sequence them to achieve diversification is also really critical. There were some offline questions, both in the session and beforehand, around what the ideal first investment looks like. Like a good consultant, I would say it depends, but it depends on what your goals are, what your liquidity constraints are, your risk tolerance. The way I've approached investing on the equity side as an LP has really been to start with a single asset class. In my case, multifamily is one I feel pretty comfortable with, and then start to meet operators in the space, get referrals from others, and ultimately try to invest in that asset class with an operator or two that I feel I can trust. And then you start to learn as you go and hopefully can do repeat business in those spaces. Okay, so I put together a set of resources to get you all started. There are a million things out there. I think my advice would be to recognize you do not need to be an expert in commercial real estate in order to invest and invest prudently. I think It's important to learn the basics. Hopefully this gets you 80% of the way there today. Find people and teams you trust who can help you underwrite or get you comfortable with the risk and return trade-offs of the asset class. And start looking at deals. And then you just begin to invest selectively. In my case, I'm looking to invest in 2 to 3 deals a year, at least for the next 5 years. And then when those investments all start to roll over, in 4 or 5 years, I will reinvest that cash flow into the next set of deals. The idea is compounding over time. If you can double every 5 years before tax and manage that tax treatment well on a portfolio basis, you can really create significant wealth over time. So anyway, here are some of the resources. I put together a list of a few articles and books. The first link, the Learning Guide on Passive Real Estate Investing. This is actually articles that I myself have written to try to get my mental model on paper. I think it's a great place to start. Passive Pockets is another one. If anyone's familiar with Bigger Pockets and Brandon Turner, he was one of the big early sites for single family home investing and the Burr method. So there's some great resources there. And then there's loads of books. I found this link here with several books I've read and enjoyed. So that's a great resource as well. Podcasts, there are many, many out there. I listed a couple that have hundreds of episodes and I think tell a lot of stories about types of commercial real estate people have invested in, which I think can be helpful. There are also paid boot camps and masterminds. Again, I do not think you need to do all this. I would not recommend you do all this. I personally have done many of these things and I've joined, boot camps, masterminds. But it's not critical to be able to make a prudent investment and build judgment. So where do you find opportunities? There is a great site actually called gplpmatch.com where GP teams can list deals where they're looking to raise capital for. I think that's a great place to be able to look at a lot of deals. You can meet and try to get comfortable with teams there that you might want to invest with. All of my deals thus far have come through private referral networks, either masterminds that have joined or referrals from other people that invest in the space. I'm more than happy to introduce you to teams either that I have invested in or I have vetted and intend to invest with in the next couple of years. But anyway, that's probably the most common way to ultimately invest. And then again, not necessary, but you can meet operators in your local real estate investment association. If you are very keen on investing in your local market, that could be useful. But again, not necessary. So hopefully this is a good list of resources to get you started. And then I'll just share my own contact information with you all as well. Best way to reach or connect with me would be through LinkedIn. I've also, again, started to publish a few articles and a more detailed version of this deck and a diligence checklist on a website I created called archlineequity.com. And then you can reach me by email or phone as well, and we can set up time to chat. I'm happy to be a resource for you. I think it's a great way to invest and compound wealth. And hopefully this gives you enough of an orientation to feel confident enough to explore this further and potentially allocate some of your portfolio there. So thank you for the time. Hope this was helpful and look forward to connecting with folks.